Now, during the process of the IPO, there's a number of different types of the options or the agreement that the underwriters and the issuers they make. So one of them is the Greenshoe provisions. Greenshoe provision is called the over allotment option. This is basically just allow the syndicate to purchase the additional 15% of the shares from the issuers, which means that they allow the issue to be oversubscribed, right? So 15% more. This provides some protection for the lead underwriters because they have kinds of this additional 15% issuers that they can use these shares as to stabilize the price. So this issue may be used to perform for them to perform their price stabilizer functions. This is very common in all IPO and SE offerings, so you can actually find Greenshoe provisions in most equity offerings, but not in that offerings. The next one is called lockup agreements. This is not legally required, but very common. This basically restrict the insiders from selling IPO shares for a specific time periods, which means that they don't want the insiders to just sell the shares so that the supply increase, the price decline, so that it looks like just a bad, IPOs. And the IPO success rate is very important for the reputation of the underwriters, the investment bank. Common lockup period is 6 months, about 180 days. And stock price tends to drop when the lockup period expires because it's more demand, like supply actually of the stocks flow into the market. So because the market anticipate additional shares hitting the street, hitting to the market. There's a phenomenon called IPO underpricing. Now, this is not like agreement or like the provisions or options. This is just a phenomenon that we usually see. And this is very common. IPO pricing is very difficult. It's really hard to find exact price. They usually use like the discounted cash flow method to find the price, but it's not really exact the market price, and they don't sell the share yet, so they don't know the market price either. So it's really very difficult job. And you see like the we don't want to basically see just the price popped up a lot, so that IPO price is too underly price, and the issuer side or underwriter side they actually get less benefit. So Dutch auctions designed to eliminate this type of the first day IPO price pop. But in many cases this actually the price popped, and this called IPO underpricing. So IPO underpricing is a phenomenon that the price of the stock just increase at the issuance date, the first date, and this money actually is just lost from the issuers and the syndicate side. So it's called the leave money on the table. The degree of the underpricing varies over time, so it's very hard to find like exact amount. So there's kinds of the effort to adjust partially during the SEC registration. Basically, the company will set a file price range, and just before the IPO, the final price is determined. So before the IPO, like the days before, they don't know the exact price, but they only know the range, and then just before the IPO, the final price is determined. And the final price may be also below, inside, above the file price range. So it doesn't have to be just a range. Historically, IPO with the final price above the file range has been far more underpriced than those with the file price below or inside the file range. So it means that if the IPO price is kind of higher than the range price, now it means that it's very wrongly evaluated during the SEC registration. So IPO underpricing is more serious. What's the reason? So IPO underpricing usually very common. There's not many IPO overpriced one. There's one example. I think Facebook IPO was overly priced. although the current price is higher than the IPO price. The price started to drop like right after the issuance date, like the IPO date. Eventually, like it popped up, but it's overly priced IPO. But underpricing is a lot more common. So the biggest issue is underwriters really want to sell everything, entire shares. If not, then the reputation is hurt. So basically, they want to they don't want to set a too high price, so the investors hate that. Oversubscription allotment also kinds of the play a role of that. Now, smaller, riskier IPOs underpriced to attract the investor. So it's a marketing effort to to sell the shares. If they don't sell the entire shares, their reputation will hurt. So underpricing is more common, and for even smaller and riskier one, people really hesitate to buy these shares. So syndicates set a price even lower. So I feel underpricing attract the investors. If you go to Huber's website here, like there's IPO Centrals, and you can actually find some examples there. So you can click the slide and go there and see the examples. Now, SEO, Seasoned Equity Offering, is called also SEO. This is similar to IPO, but this is the offerings after IPO, so it's already publicized. Now they want to issue more new stocks. And stock prices tend to decline when new equity is issued. Actually, this basically explains a little bit. Like there's a signaling explanations. First of all, stock price usually the new issue is issued when equity is overvalued, because management believe that the current shares is overvalued, so that they can choose issue stock shares, they can raise more money. So market perceive that this is signal of the overvalue, so the price tends to drop. That usage means that the issuing stock may indicate firm has too much debt, so that they cannot issue more debts. So they choose equity financing. And equity financing is kind of expensive financing, more expensive than debt financing. So this means that sometimes they max out the debt and they have to issue equity. Then that's not a good signal. And also there's a huge issue cost for the equity. There's a direct cost, indirect cost, and actually it's more expensive than that. So there's called a pecking order theory in capital budgeting. I'm sorry. In capital structure theory, and it means that the company will tend to use cheaper money first. Cheapest one is retained earning. Second cheapest one is the debt financing, and then the most expensive one is the equity financing. So the cost of issuing equity is actually very high. This is the typical cost, the spread. Basically the benefit for syndicates, the price difference between the issue received and the offer price. Now there's other direct expenses incurred by issuers, like compensation to underwriters, filing. No, this is not part of the compensation underwriters. Include filing fees, legal fees, taxes, things like that. There's also indirect costs. It's not reported on the prospectus, but there's a cost of management time spending working on this issue. So this is indirect. It's hard to measure, but obviously this is also the cost. Abnormal returns in a seasoned issue of stock, the price of existing stock drops on average 3%. So it means that there's some abnormal returns because they lose values, right? That's the cost. Underpricing. For IPO, losses arise from selling stock to low price. So that's another loss. And Greenshoe options gives underwriter to buy additional shares at overprice to cover over allotments, and that's also the cost of the issuing these securities. So the average total direct cost is 10.4%. It's huge. It's only direct cost, right? And the largest direct cost Its spread is about 7% spread, and direct cost is also very large, especially for issuance less than 10 million to smaller one, about 22.22%. So it's very high cost. Underpricing cost is about 19.3%. So the cost of issuing securities is pretty high. There's a certain patterns, a substantial economy of the scale. So large issue usually reduce the cost. So it means that the company usually try to issue large one issue, not several small issues. Cost of the selling debt is lower than issuing equity, and IPO cost is higher than SEO cost. And for bond issue, 1/3 bond issue is actually cheaper than convertible bonds because convertible bonds includes this equity function. Now this is the example of the cost. The Folk company has just gone public under firm commitment agreement. Folk received $32 for each of 4.1 million shares sold. The initial offering price is $34.40 per share, and the stock rose to $41 per share in the first few minutes of trading. Folk paid $905,000 in legal and other direct costs and $250,000 in indirect costs. What was the flotation cost as a percentage of the fund raised? Now, if you look at this, first of all, net new amount to raise should be, so you sell 4.1 million shares at $32, right? $32 to the syndicate. So that's the money you raise, and then pay the indirect cost $905,000 and the indirect cost $250,000. So the money company really raises $130,045,000. That's the money they raise. Next, we can calculate the direct cost. Total direct cost is $905,000, which is the direct cost the company to pay, and then this is a spread. The stock was offered $30 for $40, and they received $32, so $2.40 per share will be the spread, the compensation to the syndicate, and that's the direct cost for the firm. So $2 times 4.1 shares, so total direct cost is $10,745,000. Now their indirect cost is $250,000. That's the indirect cost, and then this is underpricing cost. So the offer price is $30 for $40. The price really popped up to $41 a few minutes after they actually trade. So this is the money leaving on the table, left on the table, times 4.1 shares. So 27,310,000 will be the indirect cost of this IPO. Now, total cost will be two parts. This is direct, and this is indirect. And total is $38,055,000. Now, divide by the money the company raised, then there's a flotation cost percentage, which is 29.26%. So about 30% cost is actually paid. This is very common. So that's why people call this IPO is very costly. Now let's talk about a little bit about the long-term debt. So types of long-term debt. We have bonds. Bonds is publicly traded long-term debt, and you can actually sell this bond to the public to borrow money. And there's a number of private issues. There's called term loans. It's a direct business loan from commercial bank, insurance companies, usually matured in 1 to 5 years, and you can actually repay to the bank or the insurance companies any financial intermediations, during the life of the loans. There's also private placements, usually similar to term loans, but longer maturity. The private issues easier to negotiate, because public issues is very hard. You don't know the owners and it's hard to negotiate, but this private party, right? So you can really negotiate when you have some trouble. You can renegotiate this debt with private issuers so that you can get, you can achieve your goals basically. And the cost is also lower because you don't have to register it in SEC. SEC require actually the shelf registrations, based on the SEC Rule 415. It's basically permit firm to register the large issue with SEC and sell it in a small portion. So they basically just register large issue once and then sell the smaller portion, several times. This basically reduce the flotation cost because they don't have to borrow money. They have to register every time they borrow. They basically just register large amounts and then they use poor proportions, in each. So it allows company more flexibility to raise money quickly. The self-registration required the company must be rated investment grade. So for junk bond, no way. Cannot have defaulted on within the last 3 years. So good credit again. Market value of stock must be greater than 150 million. So only large company can make this deal. And there shouldn't have no violation of the Security Act of 1934 in the preceding 3 years. So basically, they have to good company, right? Good prudent company may get this type of benefit to reduce the flotation cost. So this is the end of the chapter 15.